As we analyze the current state of the equity markets on this Wednesday, July 8, 2026, the public markets are currently closed, which means we are evaluating the final figures from the most recent active session. BigBear.ai Holdings, Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, finished its last full trading session on Tuesday, July 7, 2026, at a closing price of $3.43 per share. This represents an intraday decline of 4.19%, continuing a downward drift that has caught many short-term retail market participants off guard. While the headline number shows a clear pullback, the hidden reality is that the underlying order flow reveals a significant structural accumulation by institutional players who are quietly buying up shares while retail hands capitulate. While the average person sees a sinking stock and panics, large capital allocators are treating this price compression as a strategic accumulation zone because the company is sitting on a massive cash fortress that completely shields it from immediate insolvency risks. The common ground among most market participants today is that BigBear.ai is simply another distressed, unprofitable tech name destined to fade away as the initial hype around artificial intelligence naturally cools down. The general expectation was that federal contract wins would immediately translate into exponential top-line expansion, and because that growth has moved at a slower, bureaucratic pace, the broader market has grown incredibly impatient. However, looking deeper into the data reveals a starkly contrarian reality. The company recently posted a quarterly revenue figure of $34.4 million, and while the net loss widened to $56.8 million, the balance sheet tells a completely different story than the stock price. BigBear.ai is holding roughly $349.4 million in cash and short-term investments against a mere $6.5 million in long-term debt. This gives the company an astronomical current ratio of over 6-to-1. Investors who rely purely on simple automated metrics or look for basic investing help on popular investing sites are completely missing this massive financial buffer. They expect an imminent cash crunch, but the cold reality is that the company has enough financial runway to sustain its operations for years without needing to dilute shareholders or take on toxic high-interest debt. When you look at recent stock movements, the technical price action has been characterized by a steady fade from the mid-$3.90 level down to this current $3.43 level. This slide has occurred on trading volumes that remain slightly below the 30-day average of 31 million shares, indicating that the selling pressure is largely driven by a lack of aggressive buying rather than an onslaught of heavy institutional distribution. Active traders using advanced platforms like the Interactive Brokers trading system have noted a tight consolidation pattern forming between the $3.30 and $3.50 range. This area has historically served as a critical baseline where buyers step in to absorb the float. Meanwhile, broader sector momentum has been highly fragmented. While mega-cap technology options like Nvidia stock, Apple stock, or Tesla stock continue to dominate institutional capital allocation and dictate the direction of major indexes, smaller application software firms are dealing with severe macroeconomic pressures. High interest rates have forced corporate clients to extend their sales cycles, making it harder for mid-cap and small-cap software vendors to close commercial deals rapidly. This macro drag is causing retail traders to dump their shares through platforms like the Robinhood app or via basic automated portfolios such as Schwab Intelligent Portfolios, redirecting their capital into large-cap tech or safer index products. This structural shift in capital allocation highlights the intense tension between retail expectation and institutional reality. Many retail investors who engage in self-investing or use a Robinhood stock trading account bought into this ticker hoping for a quick multi-bagger, completely ignoring the reality that federal enterprise software deployment takes an immense amount of time. Institutional firms, on the other hand, utilize the Fidelity trading platform or Interactive Brokers stock trading tools to build positions slowly, knowing that defense and national security contracts require rigorous vetting but offer unparalleled long-term revenue stability once they are fully locked in. The broader market is treating this company like an unstable meme stock, but the data indicates it is a highly liquid, debt-free defense contractor waiting for its backlog to convert into recognized revenue. For those managing an individual brokerage account or looking at online investing options, understanding this divergence is critical. If you are looking at specialized Fidelity ETFs or allocating capital through Fidelity mutual funds, you already know that institutional managers favor businesses with clean balance sheets and protected government niches, both of which apply directly to this company, despite its short-term lack of profitability. To properly understand where the business stands today, it is essential to look at its core operational model and historical performance. BigBear.ai operates as a provider of artificial intelligence-powered analytics, specialized computer vision, and predictive modeling solutions, primarily serving the United States federal government, national security agencies, and complex supply chain logistics operations. The company operates through a highly specialized enterprise software model where they integrate their proprietary platforms into existing government infrastructure to help decision-makers analyze massive fragmented data sets. Historically, the business expanded through tactical acquisitions, such as their recent absorption of Pangiam, which was designed to bolster their biometric and facial recognition capabilities at major ports of entry. In past fiscal years, the company faced significant headwinds, lagging under integration expenses and non-cash goodwill impairment charges that severely distorted their net income figures. Older financial reports showed a business struggling with high operational overhead, which is exactly why the legacy narrative around the stock remains deeply negative. But as the integration costs of these past acquisitions subside, the structural gross margin has actually shown signs of improvement, climbing back up to approximately 34% in recent periods. This operational history shows that the company has transitioned from a disjointed group of defense consultants into a unified software provider, even though the market continues to price the asset based on its historical inefficiencies. Looking ahead at the future outlook, there are several distinct scenarios that could unfold over the next 12 to 18 months, each tied tightly to the contrast between public perception and operational execution. The most bullish catalyst centers on the conversion of the company's massive federal contract pipeline. Because the federal government operates on fixed fiscal calendars, there is often a massive lag between an announced intent to award a contract and the actual deployment of billable software hours. If BigBear.ai successfully converts its active pilot programs with the Department of Defense into multi-year recurring revenue streams, the top-line growth will accelerate rapidly, forcing analysts on major investing sites to completely rewrite their financial models. On the flip side, the primary risk scenario involves an extended slowdown in commercial adoption. If corporations continue to tighten their software budgets and look to larger aggregators for their analytics needs, BigBear.ai could find itself entirely dependent on government clients, capping its valuation multiple and leaving it exposed to federal budget delays or sudden policy shifts. Comment below how many shares of BigBear.ai you currently hold in your portfolio and whether you are buying this dip or looking for options elsewhere. For individual investors navigating these volatile waters, choosing the right venue for online investment execution can make a massive difference. Many active market participants utilize specialized tools like the Robinhood app for its frictionless access to Robinhood fractional shares and its integrated Robinhood crypto and Robinhood cash management features, allowing them to maintain liquidity while waiting for a stock to find a bottom. Others prefer the comprehensive corporate infrastructure provided by legacy giants, relying on Fidelity investments, utilizing a Fidelity brokerage account, or setting up dedicated Fidelity IRAs to manage their long-term equity exposure. Whether you prefer the streamlined interface of the Fidelity mobile app, the automated rebalancing of a SoFi robo-advisor, or the rock-bottom interactive broker's fees designed for high-frequency execution, the tools you use must align with your broader thesis. Those utilizing SoFi Investing or the SoFi trading platform often seek exposure to high-beta tech names through SoFi Active Investing, while more conservative allocators might lean toward pre-built baskets like specialized SoFi ETFs or fixed-income alternatives. Ultimately, the choice between running a hands-on self-investing strategy or using a hands-off intelligent portfolio depends entirely on your risk tolerance and your ability to look past short-term daily swings to see the deeper macroeconomic forces at play. When we synthesize this entire landscape, the central insight becomes blindingly obvious. The market is pricing BigBear.ai based on a past narrative of unprofitability and slow growth, while completely ignoring its pristine, debt-free